So in this video series, I'm showing the 4 simplest option strategies that you can use to trade stocks, and we're using Tesla stock as an example. So in part 1 of the video, I showed the first method, which is to simply buy a call option if you think the price is going to go up. And that's what most amateurs do. But I did show you in part 1 of the video that just simply buying a call option can be very risky because, number one, buying a call option is very expensive and time is working against you. So every day that passes, the option is losing value, and it's like buying a lottery ticket. Once in a while, if the price goes up fast enough and sharp enough, you're going to make a lot of money. But more often than not, prices may go up a bit or go sideways or go up slowly, and you tend to lose money simply buying call options. So the second method has more advantages than just buying a call option. So the second method we're going to learn in this second part of the video is called a bull call spread option strategy. This strategy involves 2 legs, where number one, we're going to buy a call option at the current market price. We call that buying at the money. So right now Tesla is trading at $180, somewhere around here. And we did say in part 1 of the video that we are moderately bullish on Tesla. Not strongly bullish, but moderately bullish because of the price action, right? It kind of like it's kind of like on this above the 50 moving average, retracing, found support. Looks like it could be bouncing up. The 20 is above the 40. But again, it's below the 200 moving average. So the bigger trend is not yet up. It's still in a larger downtrend, but short term, it looks like it's moving up. So we are short term, moderately bullish, but not strongly bullish. Okay, so in a bull call spread, let me write this down, bull call spread, we are going to simultaneously buy a call option near the current price, and simultaneously sell a call option at the target price, where we think the price is going to hit within a certain time period. Now again, why do we sell a call option? When you sell a call option, you collect premium, and we use part of that premium to finance the call option. So that lowers the cost of the trade. So this allows you to have a much lower cost, lower risk, and lower break-even price. So let's see how we would execute this. So let's go to the trade tab over here, and again we're going to look at 34 days to expiration. That's generally the time period that we use. Okay, so first, buying the call option, what strike price do we choose? We choose a strike price that is near the current price. We call it at the money, usually at about 50 deltas. So if you look at delta over here, 50 delta means that it is near the current price. So we're going to buy a call option at the strike price of 183.33. Okay, so we're going to buy a call option at this strike price. And how much would it cost us? Again, if you simply buy the call option, it's expensive. It's going to cost you $13, right? About $13.15. Pretty expensive, all right? But we're going to sell a call option at the target price. Now, where is Tesla going to go in 34 days? You can see that this option expires in 34 days. Now, based on this volatility, you can see that in 34 days, Tesla is projected to move by $31.90. Can you see? Plus minus $31.90. Either it goes up by $31.90 or drops by $31.90. That's the volatility. So in other words, if you think it's going to go up, that means Tesla will go up by roughly $31.90, right? Now let's round it to $30. Let's make it simple, 30 bucks, okay? So what's 180 current price plus $30? 180 plus $30 is $210, 210, okay? So we are going to assume that in 30 days, about 30 days, 34 days, right? Tesla is going to hit $210. So hence, we're going to sell a call option at that target price. So by selling this call option, how much premium do we collect? We will collect $4.42. We'll collect this premium and use it to finance this call option. So our net cost will be lowered. So in other words, net, how much do we pay, right? We pay $13, but we collect $4. So the net difference is roughly about $8.73. So how do I execute the trade? This is what I do. I will buy this call option. All right, click here, buy. There we are. We are buying the 183.33 and we are going to sell the 210. Where's my 210? My 210 is over here. I'm going to sell this guy. Boom. There we are. All right. So you can see +1 means buy. Buy 183.33 minus 1 sell 210. So the net cost of the trade will be $8.73. If you recall from part 1 of the video, if we simply buy the call option, it costs us $13. But now, by using the bull call spread, it now costs us only $8.73. So it lowers the cost of the trade and lowers the risk, because the most we can lose if we are wrong is $8.73. Now again, one contract is 100 shares. So you have to take this, multiply by 100. Our max loss is $8.73. Again, if you click on confirm and send, you can see over here. There we are. Okay, so maximum loss of the trade, maximum loss, the most I can lose is $8.73. But if the price goes up to the target price, what's my maximum profit? The most I can make is $1,794. So in other words, I'm risking $8.73 to make $1,794. Is that a good deal? Again, in trading, you always want to risk, ideally, $1 to make more than $1. Okay, so if you take 1,794 and divide it by 873, you can see it's roughly 1:2, which means you're risking $1 to make $2. So that's a reasonably good risk to reward ratio. So does this mean that in a losing trade, you would definitely lose $873? No, you only lose $873 if you hold the trade to expiration and the price has fallen. In reality, if the trade is not going your way, it's like going down, you want to cut loss way before expiration. So in that way, you salvage a lot of time value and your actual loss is a lot less than $873. So by doing that, your risk to return ratio is actually a lot better than 1:2. So let me give you an example of how the profit and loss looks like in a bull call spread. And let's compare it to the straight call that we did in part 1 of the video. So let me bring up the Analyze tab. And over here, let's assume you enter the trade on Monday, which is the 20th of March. So let's go to the 20th of March. There we go. Boom. Okay. All right. There we go. So over here, you can see again, what's the purple line? The purple line is the profit and loss today on this particular date. Okay. And the green line represents the profit and loss at expiration. Now, let's put in a few numbers over here. So what's the current price of Tesla? So the current price, the closing price that you see on the charts is actually 180. So let's just use 180 to make it simple, right? Although after hours, it actually dropped to 179. But let's put it at 180. Now, again, what's our profit target? Our profit target is $210, correct? So we're assuming that if it does go up, it will reach 210 in 34 days. That's based on the volatility calculator. Yeah. Now, what if it doesn't go up? What if it goes down? Now, if it goes down, at some point you want to cut your loss. So usually you put a mental stop loss, below the recent swing low. So we could put a stop loss, a mental stop loss at 160. So we tell ourselves that if Tesla goes to 160, we cut loss, we are out. right? If it goes to 210 and above, we're going to take profit, okay? So let's put these two numbers into the profit and loss chart. Okay, there we are. So this, let's put this to 160. Okay, 160, that's our cut loss point. If it drops to 160, we cut loss. If it goes up to 210, let's bring it to 210. That's where we are going to take profit or beyond that. So what's the advantage of using a bull call spread versus just buying a call option? Well, number one, you can see that you use less capital, right? It's a lower cost trade because if you just buy the single call, you would have to pay $13.25, and that's the maximum loss. But if you buy a bull call spread, which is known as a vertical spread, you only have to pay $8.73. So lower cost of entering the trade, lower risk. That's number one. Number two, recall that with the single call on part one of the video, your break-even price at expiration was $196. The price had to go at least $13 up just to break even at expiration because it was an expensive premium to pay for the call. But when you use a bull call spread, you can see that now the break-even price at expiration is $192. So it's a lower break-even price for you to start making money. Hence, the bull call spread has more advantages than just buying a call option. So how should you manage a bull call spread once you enter the trade? Well, let's look at a few examples. So first, let's imagine after you enter the trade, you are wrong on the direction. Let's say Tesla doesn't go up, Tesla goes down, okay? And let's say from 180, Tesla goes down to 160, which is the stop loss price. So at that point, you exit the trade, you cut loss on the trade. Now, will you lose the entire premium? Would you lose $8.73 times 100? Would you lose $873? No, you won't, unless you allow it to expire worthless. In other words, if Tesla drops and you hold it all the way to the 21st of April, look at what happens to the purple line. Again, as time passes, the purple line is dropping. Can you see the purple line is dropping? Dropping. Yeah. So you can see that at expiration, you would lose the entire $873. Now, we're not going to be so stupid to hold it to expiration and lose everything, right? Duh, okay? That's why the moment the price drops, you want to get out fast so that you lose a lot less in a losing trade. So again, let's go back to the 20th of March, which is, let's say on Monday, which you enter trade. And let's say after you enter the trade, the price drops. And let's say, you know, let's say, for example, in 15 days, the price drops to the stop loss price. What's 15 days? That will be roughly about the 5th of April. Okay, so let's say on the 5th of April, the purple line has dropped a bit and you get out. How much would you lose? You would lose 653.91. Look at the purple number in the box. You will lose 655.83. So let me put it down. You would lose 655.83, assuming that you get out after 15 days have passed and you've got 15 days left to expiration. Okay. Now, on the other hand, you can see that if Tesla from 180, it goes up, right? It goes up to 210. Okay. This is how much money you're going to make. Now, the great thing is that once Tesla goes to 210 or beyond, now time is working in your favor. Time is not working against you. Time is working for you. Why? Because check this out. Notice what happens as time passes. The purple line will now move up to the green line, which means the longer you wait, the more money you're going to make. And you will maximize your profits at expiration. Okay? So that's the great thing about the bull call spread. Once the price goes up, the longer you wait, the more of the maximum profit you get. But if the price drops, then the faster you exit, the less the losses will be. So you can see that the bull call spread has more advantages than just buying the straight call, because the bull call spread, it costs less money, right? Instead of $13, it's only $8, and it's got a lower break-even price. But they both still have the same problem, which is they both suffer from time value loss. In other words, if you enter the trade and the price doesn't go up enough, if the price stays where it is or falls, you will lose money every single day. So that's why I don't really use the bull call spread as well very often. So what's the third method? Okay, now the third method I'm going to show you solves all these problems. The third method I'm going to show you doesn't suffer from time decay, number one. And number two, instead of paying $13 or paying $8, you pay very little. In fact, you may even pay nothing, or you may even be paid a bit to enter the trade. So what's this method? Okay, so this method is called the bullish synthetic spread method. How does it work? In a bullish synthetic spread, we are going to buy a call option and sell a put option at roughly the same price. Why? Because remember, when you sell a put option, you get money, and we're going to use the money to buy the call option so that the overall trade becomes free. Let's see how it works. Okay, so let me show you how you could use what we call a bullish synthetic spread strategy. A bullish synthetic spread, basically what it does is it replicates owning 100 shares of stock without paying any premium, or paying very little premium, and without the risk of time decay. But to enter the trade, it takes less capital as compared to actually owning 100 shares. But the profit and loss is exactly the same as owning 100 shares. So again, let's see how we could set up this trade on Tesla. So again, same setup. We are assuming that Tesla is going to go up to a target price of 210. If it drops to 160, we're going to cut our loss. So it's the same setup, but using a different options strategy to execute the setup. So let's go to the trade tab. And the first thing is to identify the days to expiration. Now for bullish synthetic spread, usually I would use about 60 days, because it doesn't matter, because a longer duration doesn't mean it's more expensive. Okay, so usually I use 60 days to give it a lot more time. But you can use 30 days as well, no worries. So let's go to 60 days, and the first thing to do is to decide which call to buy. And usually I buy a call which is near the current market price. So again, the current market price is 180. All right, so I'm going to choose a call option which is around 180, or I can look at a delta and choose like a 50 delta. Okay, so the closest would be 52 delta. That's the closest to 50, and so that would be buying the 185 call strike. So again, I'm going to buy a call option at 185 strike price. Now, how much would it cost me to buy this call option? It will cost me $17, which is very expensive to pay 17 bucks to buy a call option, right? So to finance the call option, I will sell a put option to finance it. So which put option should I sell? I need to sell a put option that would get me at least $17 in premium to offset the cost of the call. So which one would have at least 17 bucks? There we go, $18 there. So this would be the 180 put. Okay, so in other words, I'm going to sell the 180 put and collect $18 and use that $18 to pay for the 185 call at 17 bucks. So I collect $18, I pay $17, I still get $1, right? So not only is it a zero cost trade, but I get paid $1 to enter the trade. So let me show you how I would enter the trade. So again, I'm going to buy the 185 call, click buy, boom, there we are. And I'm going to sell the 180 put. So I'm going to click sell, boom, there we are, all right? So you can see that, all right, I'm going to buy 185 call, sell 180 put, and instead of paying any money, I'm getting paid a credit of $1. So a minus sign means I'm being paid $1. Times 100, I'm being paid $100 to enter the trade. Now, again, bear in mind that just because it is a zero cost trade and I'm being paid $100 doesn't mean it's a zero risk trade. No, there's still a risk, right? Why? Because by using a bullish synthetic spread, it's the same risk and reward as owning 100 shares. It's the exact same profit and loss as owning 100 shares. So let me show you what the profit and loss graph looks like. There we are. So you can see that this is a straight line profit and loss graph, which is exactly the same as you buying 100 shares. No difference, okay? So again, you can see that right now, Tesla's at 180, okay? Now, what if Tesla drops to 160? How much money do you lose? Okay, so if it drops to 160 and you cut loss, you will lose about 1840 thereabouts, right? You would lose $1,840. So I'm not saying it's a risk-free trade. I'm saying it's a zero-cost trade, but you still lose money if it drops to 160, right? Because it's like buying 100 shares and it drops to 160, you cut loss, you also lose 1840. No difference, right? Now, if it goes to 210, which is our target price, how much do you make? Well, you can see that even if you let it expire, between the purple line and the green line, there's not much difference, right? So let's take the green line. You will make about 2616 to 2985. If you take an average of that, it's about $2,800, right? $2,800, right? There we go. So what's the advantage of doing this versus buying 100 shares? Why don't you just buy 100 shares? Because if you buy 100 shares, how much would it cost you? If you buy 100 shares of Tesla at 180, it would cost you $18,000, right? But by doing this, you don't need $18,000, right? With a margin account, you can see by doing this, your actual buying power that's blocked from your account is 8863. So 8863 versus $18,000. Oops, yeah, versus $18,000. Basically, it only requires 50% of the usual capital. So it uses less capital to control the same 100 shares, but without the risk of time decay. So you can see that as time passes, let's say from the 20th of March, right, time passes, you can see there's no effect, right? There's hardly any effect between the purple line and green line. Now, traders who use this strategy must have the discipline to cut loss once the stop loss price is reached. So in this case, if Tesla goes down to say 160 or whatever's the stop loss price, you got to close the trade. Because if you let it keep going down and it expires deep in the money, you can be assigned shares of Tesla stock, which is not what you want, right? So you got to be disciplined to cut loss fast and follow the rules. Now, some people may say, but you know, what if Tesla goes to zero? If Tesla goes to zero, which is unlikely, but if it goes to zero, I could lose a lot of money, right? Well, unlikely. But again, if you're afraid it goes to zero, what you could do is you can also buy a put option at say about 150. So that protects your downside. So by doing that, you turn it into what we call a bull-bung spread, which is something that we teach in our option courses, where you buy a call, sell a put at the same price, and buy another put as a protective put to protect that bullish synthetic spread. It was invented by my good friend Bang Pham Van. But again, we'll cover that in detail in the option courses. So far in this two-part video I've showed you 3 different option strategies. Number 1 was to simply buy a call option. Number 2 was to use a bull call spread. And the third method, which is what I'm talking about now, is to use a bullish synthetic spread. The problem with these 3 methods is that you need the stock price to go up. If the stock price goes up, then you make money. If the stock price doesn't go up, price goes down or stays the same, you don't make money, or in the first 2 examples, you lose money. So, is there a method where you don't need the stock price to go up to make money? So the stock price can go up, it can go sideways, or it can even go down, and you make money in all 3 directions. Yes! And that's my 4th method, which is my favorite method, the method I use the most. That's called a bull put spread. And I'll be covering that in part 3 of this video series. So make sure you subscribe, and I'm going to show you this next method in the next video. I'll see you guys soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.